Hi class, in this video we'll go over Chapter 28, Monetary Policy and Banking Regulations. So we briefly mentioned about the Federal Reserve in the last chapter. So remember, Federal Reserve is the central bank of America. So every single major economy in the world, they all have a central bank. So the role of the central bank is really to regulate the financial industry in each country and also try to conduct a monetary policy for each country. So the U.S. central bank is called the Federal Reserve. Currently, the Federal Reserve is run by a system of 12 regional banks and also governed by 7 board of governors. And those governors are appointed by the president and then confirmed by the Senate. So for the 7 board of governors, each board of governor is serving a 14-year term. And you're gonna think about this a little bit, right? So the president served a 4-year term. We have senator who serve a 6-year term. Representatives serve 2-year term. But this 7 board of governors serve 14-year term, so longer than any elected official in the government. And the reason why that is because we want these 7 board of governors. Now, this is imagine the Justice League, right? So or the Avengers. So this is the most powerful position in the U.S. economy because whatever this 7 board of governors do or say, it have an impact on the U.S. economy. So we want these 7 board of governors to be independent of our politics. So whenever these 7 board of governors, whenever they're making a decision on the U.S. economic policies, they're only making in the best interest of the U.S. economy, not any party in control. So for example, most recently, President Trump had a little fighting going on with the Federal Reserve toward the end of his presidency. So President Trump wanted the Federal Reserve to lower interest rate, try to stimulate the economy even more, but the Federal Reserve was worried about inflation and they were a little hesitating about lower the interest rate. So because the Federal Reserve is looking in the long-term picture, so beyond the 4-year term of any president, but for the parties, they might have a short-term perspective. All right, so our current chairperson, so out of the 7 board of governors, 1 person is appointed as the chairperson of the board of governors, and that chairperson is appointed once every 4 years. So 4 years, therefore, the chairperson can be appointed by each president. So each president have a chance to appoint their own chairperson. So Jerome Powell is appointed by President Trump, and then it's being reappointed by President Biden. And then before Jerome Powell, it was a lady named Janet Yellen. Janet Yellen was the first female chairperson of our Federal Reserve, and today she's our first female Secretary of Treasury. So this chairperson is the most important position in the U.S. economy. All right, so our Federal Reserve is made up of 12 regional banks. So guys, if you take a look at your dollar bill, so if you have it in front of you, take it out and then look at what's on your dollar bill. And on your dollar bill to the left-hand side, there's a little seal with a letter in it. So it might be letter B, letter F, letter C. And then next to those letters so in the seal has little fine print. And it was actually say which Federal Reserve printed this dollar bill. So our U.S. Federal Reserve System is made up of 12 regional Federal Reserve banks. And then if you look at this map over here, we have the Federal Reserve Bank in Boston, New York, Philadelphia, and then Richmond. Now this star here, that's the office of the Board of Governors. So that's where the 7 people meet. That's in DC. And then we also have go to the west, meaning Minneapolis, Kansas City, and then the one that oversees the entire state of Texas. Also the northern part of Louisiana, southern part of New Mexico, that's in Dallas. And then this one, the San Francisco Federal Reserve Bank. Now notice how big the San Francisco Federal Reserve Bank area is. So not only does it see the entire western U.S., also Hawaii, Alaska, and then Guam. So the biggest Federal Reserve Bank is the San Francisco Federal Reserve Bank. But if you look at the East Coast, it's very, very much congregated together, right? So if you look at the East Coast and if you divide by the same area, looks like this is about the same area as our West Coast, right? So you have your Boston Bank, New York Bank, Philadelphia, Richmond, Cleveland, Atlanta, St. Louis, and then Chicago, all in the same area. But On the West Coast, it's governed by just one central bank or one Federal Reserve regional banks. And the reason why that is because this map here was developed back in 1913, so more than 100 years ago. So more than 100 years ago, think about what the US economy was like, right? So back 100 years ago, most of the economic activities was all on the East Coast. And then the West Coast, that was the Wild Wild West. There wasn't much going on in the West Coast, right? So there was very little economic activities and also banking operation on the West Coast, but there were a lot of it on the East Coast. That's why we need more US Federal Reserve banks, the regional banks, to oversee the individual banking operation in each regional area. That's why you have more regional banks in the East Coast than we do on the West Coast. Now today, the San Francisco Federal Reserve Bank is overseeing one of the largest operations of any U.S. Federal Reserve Bank in the system. But the most important Federal Reserve Bank, the most important one, is actually the one right here, the New York Federal Reserve Bank. Couple reasons. So one, because think about what the Federal Reserve Bank does. So one is to regulate our banking operation. So what do we have in Wall Street? Or what do we have in New York? Wall Street, where all the banks are, right? So all those major banks whose headquarters is on Wall Street, they fall under the regulation of our New York Federal Reserve Bank. And second, again, Wall Street, that's where money is, right? So for U.S. Federal Reserve Bank, our monetary policy, so for all the buying and selling of our government bond, is all conducted at the New York branch of the Federal Reserve banking system. So that's where the government bond is being sold and bought. So that's why New York branch is the most important branch out of the 12 banking system. All right, so there are three important roles for our Federal Reserve. So first is to conduct monetary policy. Now, what monetary policy is, that's when the government is using the interest rate to influence our economic outcome. That's the monetary policy. And then also to promote stability in the financial system, to make sure the banks are operating in a very safe environment. And lastly, it to provide banking services to commercial banks and other depository institutions, and provide banking services to the U.S. federal government. So one thing you can think about is that your federal bank is also, for its Federal Reserve, is also working as the middleman between each individual banks. Right, so imagine that, let's suppose you write me a check. So let's say you want to get an A for the class, and you want to pay me, I don't know, $1 million. So if you write me a check for $1 million, and then if your check is from Bank of America, and if I go deposit this check to my bank of Chase, there's a problem here. The Chase will never talk to Bank of America. So what Chase will do, Chase will send this check to our Federal Reserve, and then Federal Reserve will get the money from Bank of America and then deposit into the Chase account. So the Federal Reserve is also working as the middleman to clear checks between banks, right? So it's also doing many of the banking operations in the system, okay? All right, so for banking regulations, there are a couple of things we want to talk about for the banking regulation. This is very, very important because for any country to have a very healthy financial system, we need banking regulation. And if you look at what happened in the Great Depression in 1929, there were many bank failures. So many banks declared bankruptcy. That was because we didn't have a strong enough banking regulation, right? So for the banking regulation, it's intended to make sure the banks are solvent. That means they have enough cash to cover any potential risk in the system. And then for the regulations can fall into three categories. They're called reserve requirement. So how much cash the bank must hold on to. Capital requirement. So how much of the owner's investment must be in the bank. Because whenever the banks are losing money, so let's say I open a bank. Let's call this the Bank of X. And then from a Bank of X, so the owner's capital, so let me call this as capital. It's hard to write with a mouse. So let's suppose my capital is $10. So I'll put in $10, and then the deposit. So I would collect, let's say a $90 deposit. So my total asset in the bank is going to be $100. All right, so let's suppose this bank, something bad happened. Let's suppose this bank, we say the bank lost $9. So if the bank loses $9, we're gonna lose the capital first. The capital lose money first because supposedly the deposit never lose money. That's why we have the Federal Deposit Insurance Corporation, right? But for now, if I lose $9, that means the owner will lose $9. So after I lose $9, then this become $1 for the capital and $90 for the deposit, right? So what happens now is that my $1 is able to control 90 additional dollars. So if that's the case, I might be willing to engage in more risky investment. Because if I win, I win a lot. If I lose just my own $1, right? So for many banks, we do have this capital requirement that we require the owners to put in at least, at a minimum, a certain percentage of the total asset into the bank. So therefore, that whenever the bank loses money, we have enough money for the owner to lose before the depositor lose any money. And lastly, we also restrict on the type of investment banks can make. So your bank owners cannot go to Vegas, gamble, so that's too risky. Cannot go to the stock market, that's too risky. So your local banks can only engage in commercial lending, right? So lending to either companies, homeowner for mortgage, or personal lending. So some of the safest investment out there, and a lot of requirement too. All right. So there are several government agencies that oversee the banking operations. The most important one, the most well-known one, is called the OCC, stand for Office of the Currency Controller. So what they do, they actually conduct timely audit on the banks. So every 6 months, 3 months, 1 year, to see if the bank is operating in a safe environment, to make sure they're not engaging in any risky business. We also have the National Credit Union Administration. So your OCC oversee the regular banks, but if you have a credit unit, that's overseen by the National Credit Union Administration, and the Federal Reserve oversee everybody on top of that. Okay, so 3 agencies that oversee the banking regulation in America. One thing we try to prevent is something called a run on the bank. If you guys remember this from your U.S. history class, probably not much. So let's learn a little bit about the U.S. history from a Chinese guy. So back in the Great Depression, there were many bank runs. That means the depositors all ran to the bank, get the money out, right? Get your deposit out. But the thing with our banking system, right? So the banks, once they take the deposit, they don't just hold on to it. They lend it out. So any banks, they don't have enough cash when all the depositors try to withdraw the money out, right? So the moment when the depositor go to the bank, try to get the money out, and the bank says, "Sir, I'm so sorry, we're out of cash." When that happened, the bank is called insolvent, and an insolvent can cause the bank to go to bankruptcy. So if you guys look at what happened with the Silicon Valley Bank in 2023, that was a run on the bank. But the only difference is, back in 1930s, a run on the bank means you had to literally run to the bank. But in 2023, hey, we just get the phone out, right? Get your app open, transfer the money out directly, right? So it's not a bank run anymore. It's more like a bank, like a phone swipe. The process made it so easy that it also made the banking operation more risky. The depositor can easily get the money out. So that can cause the bank to go down. Now, to prevent that from happening, we have something called a deposit insurance. So something called a FDIC. Now, I believe you all learned this before in your U.S. history class, right? So that stands for the Federal Deposit Insurance Corporation. Now, the reason why I know you learned it before, because I learned this when I was in high school, so you must learn it too. So FDIC stands for Federal Deposit Insurance Corporation. And what it does, it insures our deposit in the bank right now up to $250,000. That means if your bank goes down, don't worry about it. Your money is fully guaranteed up to $250,000. Now, what if you have more than that, right? So let's suppose you have $1 million in the account. that if your bank goes down, then the first $250,000 is fully guaranteed. Then anything more than that is not guaranteed anymore. Well, what can we do? Well, this is where marriage coming as a convenient. That if you're a married couple, you can double that amount. You can have up to $500,000 in the account that's fully guaranteed. Well, what if you're not married? What if you have even more money than that? So if you guys know, so there's an NBA player in Milwaukee, the power forward from Greek. I can never pronounce his last name. He has a very long last name. So search him. So he's actually famous. That this guy has has accounts in over 50 different banks, just so he can take advantage of the $250,000 per account. That's our FDIC. Okay. All right. Also, one thing the bank, our Federal Reserve also do, it will also act as a lender as last resort. So whenever the banks are short on cash, they can always go to our Federal Reserve, get the money out, right? So they always borrow money from Federal Reserve. That's called a lender as last resort. All right, so now the most important function for the Federal Reserve is to conduct our monetary policy. So monetary policy, like I mentioned in the beginning chapter, is whenever the government is using our interest rate to influence our economic activities. That's called a monetary policy. So for this interest rate, think about what is the value of money. Well, let's put it this way. What is the price of money? Well, that's odd, right? So what do you call the price of money? Well, the price of money is interest rate. That is the price of money. So that's how much it costs you to hold on to money, right? So for this interest rate, how much our money demand, money supply is in the economy can influence our price level of money, which is interest rate. And this interest rate will have an impact on our consumption, our investment, and therefore on our aggregate demand curve. So in the Federal Reserve, this monetary policy tool is called an open market operation. That's whenever the Federal Reserve is either buying or selling U.S. government bond. Now this is very important. The Treasury bond, that's only coming from U.S. government. So we don't buy any company bond. We only buy and sell the U.S. government bond. So bond is a piece of IOU paper, right? So let's say the U.S. government says, hey, I owe you $100. I'll pay you back next year. That's a bond paper. So Federal Reserve is actively buying and selling this government bond to conduct our open market operation. Now, the people who are in charge on this, it's called a Federal Open Market Committee. Now, the FOMC, the Federal Open Market Committee, has 12 members. There are 7 board of governors and also 5 of the regional president. The New York president is always there. And that's because all this open market operation, the buying and selling bond, is conducted at the New York branch of Federal Reserve Bank. All right, so let's see how this works. So let's suppose we have a bank's balance sheet or a T account. So we have, this is what the Happy Bank. Start with $460 million in asset, and then that asset divided in $40 million in reserve. Remember, that just means cash. Bond, so that's the government bond. And then loan, so this is the lending to other business or homeowners. Deposit total of $400 million, and net worth or the owner's equity is $60 million. Now, if this bank decide to, so if the central bank, so Federal Reserve, decide to purchase $20 million of bond from the Happy banks. So if the Federal Reserve buy bond, when they buy bond, they're giving cash to the banks. So that when they buy bond, your bond decreased by $20 million. But what do we have instead? We're going to have extra cash in the bank, right? So whenever they buy bond, that means more cash or more money supply in the economy, because this extra cash, now the banks can lend the money out. Remember our money multiplier? So when the bank lend the money out, that's additional money creation in the economy. Now vice versa. Let's suppose if the banks want to All right, so now we still have the same scenario. So we start with $40 million of reserve, 120 in bond, and then 300 in loan. But now instead, let's suppose the Federal Reserve Bank says, we're gonna sell bond. So sell bond to this bank over here, sell bond, and we're gonna sell $30 million of bond. Now, when you sell bond, then your bond is increased by $150 million, increased $200 million, but at the same time, your cash goes down by $30 million. So now you only have $10 million cash. So with less amount of cash available, then there will be less amount of loan the bank can lend out, right? So sell bond, whenever the Federal Reserve sell bond, we're gonna see lower money supply. And vice versa, when they were buying bond, we're gonna see more money supply. And that's the open market operation. So buy bond, that will increase money supply. Sell bond, that will decrease money supply. Okay, so the second tool our Federal Reserve can use is called a reserve requirement. So remember we talked about this in the last chapter. So every bank are required to hold on to a certain portion of the deposit in terms of cash. They cannot lend everything out, right? So that requirement is called a reserve requirement. If the government decides to increase the reserve requirement, that means less money available for lending, so lower money supply. And then vice versa, if we decide to have a smaller reserve requirement, then there will be more money available for lending, so more money supply, right? So second tool we have that the reserve requirement, if this is changed, then this can also cause a change in our money supply in the economy. This tool is very rarely used because it's very risky. That for the reserve requirement, more than often it's easier for banks to lower the reserve requirement, but it's difficult for them to get additional cash to cover the reserve requirement. And also, whenever the economy slows down, so with a slowdown economy, you want to have more money supply. But if using reserve requirement, doing that, you need to lower the reserve requirement, which means more risk in the banking system, right? There are less money available that's in the bank's balance sheet. So with more risk at a recession, then you are making the economy even worse. And that's why this tool is very rarely used. Number three, we have something called a discount rate. So discount rate, now remember we said the Federal Reserve is the lender as last resort. So your banks, whenever they're short on cash, first what they will do, they will call other banks first to borrow money. But if nobody lend the money, they can go to our Federal Reserve borrow money. But that's not free money. When they borrow money from Federal Reserve, there's an interest involved. And that interest rate is called a discount rate. So we can use discount rate to influence how much our market interest rate is. So if the banks are paying a very low interest rate when they borrow money from the government, then when they turn around, they're going to charge the consumer a very low interest rate as well. And then vice versa, if the bank charges a very high interest rate, so if there's a very high discount rate, then the banks also need to charge a higher rate on the consumers, then there will be, lower level of money supply in the economy. So this discount rate is very widely used, but it does have a problem, and the problem is the lowest level is 0%. Then we cannot go below 0, right? So for the discount rate, once you reach 0%, then this tool here is all used up. There's nothing else we can do anymore. All right, so whenever we try to pump up the economy by introducing more money supply, that's called an expansionary monetary policy. So whenever the economy is in recession, we're going to use the expansionary monetary policy. Whenever the economy is in an inflation, we try to cool it down, we're going to use this contractionary monetary policy, right? So try to pump it up, that's expansionary. Try to cool it down, that's contractionary. And then for the federal funds rate, so this is the interest rate that banks charge each other. So before the banks go to the Federal Reserve, they'll go to other banks first. Says, hey, Bank of America, I'm Chase. I need to borrow $10,000 from you. Well, this loan is not free money. There's an interest involved, and that interest rate is called a federal funds rate. So again, our U.S. Federal Reserve, we don't set what the federal funds rate is, but we influence the federal funds rate with our discount rate, right? Because at the end, let's suppose your federal funds rate, so banks charge, let's suppose 10% between each other, and then the Federal Reserve says, it's okay, come to me, I'm going to charge you a 1% federal discount rate. Then what happens? Then anybody who need money, they all go to Federal Reserve, then the federal funds rate will be lowered because there will be lower demand for it. So Federal Reserve, we don't set the federal funds rate, but we do influence our federal funds rate. So imagine this is our money market. So remember we said that the price for money is interest rate. That's the price level for money. So the supply for money, that's decided by the Federal Reserve. The demand for money, that's how much we need money for in the economy. So every time if you have an expansionary policy, so more money supply in the economy, you're going to see a lower interest rate. And then vice versa, if you have a contractionary policy, so shifting the supply curve to the left, then you're going to end up with a higher interest rate, and that's a contractionary policy. And this interest rate is important because remember, all your business, your consumers, when we borrow money, how much the interest rate is very, very important. So look at what is happening in 2023 for the housing market. Now 2021, 2022, the housing market was super hot because the interest rate was very, very low. But in 2023, we have a higher interest rate now that most people don't buy home anymore, because with a higher interest rate, it also means higher monthly payment, right? So this interest rate will help our government try to conduct our monetary policy. So when we try to use a contractionary policy, then we're going to see a higher interest rate, which means lower business investment and a lower consumer borrowing. And vice versa, if you have an expansionary policy, we're going to see a lower interest rate, so very low interest rate, then business borrow more money, so more investment, and also more consumption in the economy. So both of them will increase whenever you see a low interest rate. All right, so this is how we use it in the bigger picture. So on the left panel is panel A at point E0. See how we are added to the left, our long run supply curve. Remember, to the left, we have recession. Recession. Now, what do we do with the recession? We're going to use our expansionary policy, so lower interest rate. Lower interest rate, you're going to see a higher consumption. You're going to see a higher investment, and therefore your aggregate demand curve will be shifted to the right. When you go to the right, we go back to our long run potential. And then vice versa for this one over here, for the one on the right, that we're operating to the right side of our long run supply curve, then this will be called inflation. So with inflation, what do? We're going to try to cool the economy down. So by cooling the economy down, we're going to use our contractionary policy, so higher interest rate. And with a higher interest rate, then we're going to see low consumption. We're going to see low investment. And the aggregate demand curve is shifted to the left, and I'm going to end up at 81 and end up back to our long run potential. So push economy back to where it should be, right? So this is our expansionary policy and our contractionary policy. So what you notice is that our monetary policy here is called a counter-cyclical. That means whatever the business cycle is, our monetary policy will act against that, right? So whenever we have a recession, that means the economy slows down, our monetary policy try to pump it up. Whenever we have expansion, the economy getting too hot, then the monetary policy try to cool it down by using contractionary policy. So it's against the current business cycle. All right, so for our monetary policy, this is the process for it. With expansionary monetary policy, we're going to see more money supply, so there are more money available in the economy. With more money available in the economy, we're going to see lower interest rate. With lower interest rate, there will be a higher investment, higher consumption, and therefore higher real GDP. So economy recovers from recession. And then vice versa. If you have a contractionary policy, that means it's going to reduce our money supply, so there'll be less money available in the economy. That means higher interest rate, so lower investment, lower consumption, and therefore lower GDP. Try to cool down the economy, right? So that's the pathway of our monetary policies. And you can also tell that from our graph over here that our monetary policy, that will be the federal funds rate. So this is the sign of our monetary policy. It's always in between our unemployment rate and also our inflation rate, right? So every time that our inflation is going up, so inflation is going up, we also increase our federal funds rate, so higher interest rate, try to cool down the inflation. And whenever the unemployment is up, so that will be right here. So see this high unemployment rate, then we're going to try to lower the federal funds rate, make borrower cheaper. So consumer business borrow more money and the unemployment rate goes down, right? So we're going to play a very fine balance here between our unemployment rate and our inflation rate. Another tool we have that's become very popular in 2008 is called a quantitative easing. So quantitative easing means that the Federal Reserve actually actively purchase the securities and loans from the banks. Therefore, there will be more cash on banks' balance sheet. So remember we have our asset account on the bank's balance sheet, right? So under asset, we have reserve, and then we have loan, right? So those are the two accounts on there. So how much the banks can lend out is how much the reserve is. The more reserve they have, the more money they can lend out. But sometimes this reserve might be tied down in loan. So if the banks are able to sell some of the loan to our Federal Reserve, and then in return to get more reserve back, so there will be more lending available. And that's called a quantitative easing. So imagine that if you go to our local bank, borrow money, say, hey, Bank of America, I want to borrow $10,000 from you. So you did it. But next day you get a letter in the email that says, hey, Bank of America no longer owns your loan. Your loan is now in the hand of another bank or some other institution. And that's called a quantitative easing, that your bank sold this loan to the Federal Reserve, get the cash back, so they can offer more lending in the system. All right, so also known as excess reserve. So this is any reserve that's more than the additional, so more than the required reserve. That's called an excess reserve. So your banks, they don't want to hold on to any excess reserve, because the more excess reserve they have, that means they're not making any profit from lending. So excess reserve is bad in the banking system. But however, whenever the economy goes down, whenever there's a very bad economic indicators, so economy goes through recession, then for many banks, you try to have a very high excess reserve, try to maintain stability, right? So, but normally they want to have a very low excess reserve. Also known as velocity. So velocity is how fast money circulate in the economy. So how fast money change hand. And that's the formula for it is your nominal GDP divided by the money supply. And then if you remember this from the previous chapter, that your nominal GDP also equals to your price level times the real GDP. So another way to write this formula is that your money supply times velocity equals to the price level times the real GDP. Right? So this formula here is very important. Okay, so money supply times velocity equals to the price level times real GDP. All right, so if you look at our velocity of money in the U.S. economy, it's pretty steadily, in the 1960s, 1970s, and then slowly increased a little bit. But you see this huge jump around this time. That's when the economy was very, very hot. And then we had an '08 recession. The velocity went down. And then in 2020, the number went way down. And that's the March 2020 pandemic, right? So when the pandemic happened, people don't spend money anymore. Therefore, velocity for money goes way down. So one other thing that Federal Reserve try to do is try to target our inflation. So this has become a very popular policy for many central banks in the world. So when they're targeting inflation, they try to keep inflation at a certain level. And then anytime the inflation goes above that, the Federal Reserve will try very hard, try to push the inflation back to where it should be. And that happened in 2021, 2022. So when the inflation went way over, so in 2022, our national inflation was as high as 9% per year. The last time we had a 9% per year was back in 1980s. So because we had this inflation targeting policy, then the Federal Reserve decided to conduct a contractionary monetary policy, so lower money supply, increase interest rate, lower spending, which means lower price level, right? So that's the inflation targeting policy we have in the Federal Reserve. All right, so lastly, for a neoclassical view of economics, so for Keynesian view, that they believe the long-run aggregate supply curve is more flat, that whenever you change your aggregate demand curve, you're going to see a real change in your real GDP. But for the neoclassical view of economics, they believe that our long-run supply curve is perfectly vertical, so now if you change your aggregate demand curve, the only real change you're going to see is they're going to see some real inflation happening. So according to the neoclassical view of economics, the long-term impact of expansionary monetary policy, all we're going to have is either inflation or deflation in the economy. They wouldn't cause any real change in unemployment rate or real GDP in the long run. Okay, all right, guys, that's it for this chapter. Let me know if you have any questions, and I will see you for next chapter. All right, bye-bye.